So now let's talk about bank accounts. And I'm sure that we all understand bank accounts. We've used bank accounts, especially that we all use checking accounts for writing checks and keeping our cash in the bank. So for companies, bank accounts are even more important because it's a way of protecting their cash and also as a third-party verification for transactions that any business would go through. So a major reason that businesses use bank accounts is for internal control. Some of the control advantages of using bank accounts are bank accounts reduce the amount of cash on hand. Also, bank accounts provide an independent recording of cash transactions. So reconciling the balance of the cash account in the company's records with the cash balance according to the bank is an important control. Also, bank accounts are used as a way of facilitating the transfer of funds using EFT systems. So if we're talking about bank accounts, we need to understand bank statements. And the bank statement is the document that's sent by the bank, usually on a monthly basis, showing all transactions that took place during the month and what was the beginning balance and what is the ending balance. So banks maintain a record of all checking accounts transactions. A summary of all transactions called a bank statement is usually mailed every month to the company or to the depositor or made available online. And I think nowadays it's always encouraged to receive these kind of statements online because it's more secure that way. The bank statement shows the beginning balance, additions, deductions, and of course the ending balance. And the ending balance is an important thing that we want to make sure that it's not too far from what we have. And we'll see why we'll find some differences between the ending balance on the bank statement and the ending balance on our records. Of course, the bank statement would show us any kind of deposits and any kind of cash payments that took place through the bank. And here we have an example for a bank statement. Of course, different bank statements vary from one bank to another, but they usually show the name of the bank, the name of the depositor or the client for the bank, the account number, the beginning balance, the ending balance, and any kind of deposits and withdrawals or payments that took place during the month. And then sometimes they also show detailed payments using checks and other ETFs. So the company's checking account balance in the bank records is a liability. Therefore, in the bank's records, the company's account has a credit balance. And this is another thing that's very important for us. We all know that cash is an asset, and from our perspective, an asset has a debit nature. But when we deposit this cash to the bank, from the bank's perspective, this is a liability. It's not their own money. So they show it as a liability, and they present this liability on the credit side. So when you're crediting your bank account at the bank, this means that you have more cash deposited in the bank, but the bank shows it as a credit balance. On your side, of course, it's on the debit side. So this is like the image of what we have in our records. It's the opposite image of what we have in the records. So because the bank statement is prepared from the bank's point of view, a credit memo entry on the bank statement indicates an increase or a credit to the company's account. Likewise, a debit memo entry on the bank statement indicates a decrease, or in other words, a debit in the company's account. And this is very important because some people get confused why the bank is showing a credit balance. If cash is an asset, why it shows as a credit? But it's from their perspective, it's a liability on their side. The bank makes credit entries for the following reasons, and this is usually done by issuing credit memos or credit memorandums. So deposit made by electronic fund transfers or EFTs, collections of notes receivable for the company, proceeds for a loan made to the company by the bank, interest earned on the company accounts, or any kind of corrections if the bank made any kind of error. As you can see, all of these things are considered to be things that would increase our cash balance, yet we use the credit memo. On the other side, the bank makes a debit memo for these kind of following payments. And again, you see that we call it a debit memo, even though it's a decrease in our cash balance. But because again, the bank is showing their liability side, so that's why they're reducing the liability. So payments made by electronic fund transfer, service charges, customer checks returned for non-sufficient funds, or any kind of corrections. So again, you can see that all of these are considered to be cash payments, and they are transactions that would reduce the cash balance for the client. I hope you notice that corrections go both sides. So it could be an increase or a decrease. So it could be a credit or a debit, depending on the situation. So here we have like a side-by-side, the company versus the bank. So as you can see here, cash for the company, it's an asset. We call it cash in bank. We have a beginning balance on the debit side. All the increases are recorded on the debit side, and all the decreases are recorded on the credit side. From the bank perspective, they show it as a liability, and they just list the company name or the client name, and their balance is expected to be on the credit side because that's the liability, and any kind of increase in the liability is affected by those credit memos, and any kind of decrease in the liabilities is affected by the debit memos. And as you can see, this is just a side-by-side comparison that shows the image between how the company presents the cash and how the bank presents the cash. So the following types of credit and debit memo entries are found on a bank statement. So we see these abbreviations all the time. So EC stands for Error Correction to Correct Bank Error. NSF stands for Not Sufficient Funds Checks, and this is whenever we receive a check from a customer, we try to deposit in the bank, and then the check bounces back. This means that the customer didn't have enough cash in their checking account, and then the check was returned. That's a non-sufficient fund check. There's also service charges, which is the bank would charge us on a regular basis. We also have ACH, which is Automated Clearinghouse Entry for Electronic Fund Transfers. And MS stands for Miscellaneous Items, such as a collection of a notes receivable on behalf of the company or receipt of a loan by the company from the bank. Now let's talk about using the bank statement as a control over cash. And here the cash balance shown by a bank statement is usually different from the company's cash balance. Differences between the company balance and the bank balance may arise because of a few reasons. One of those reasons is a delay by either the company or the bank in recording a transaction. It could be also the bank has debited or credited the company's account for transactions that the company would not know about until the bank statement is received. And this is why I call it information that the bank knows but we don't know about until we get the bank statement. And then it could be simply errors, such as an incorrect posting made by either the company or the bank. So this creates a problem. In many cases, we receive a bank statement and we compare it to our records, and you see that there's some kind of differences. So we see here that the ending balance is about $33.59, and the ending balance in our records is only $25.49. So why does the bank statement shows more than we have in our records? This is what we're going to be trying to explain in the next video. So here, as you can see here, Power Networking should determine the reason for the difference in these two amounts. So in the next video, I'm going to show the bank reconciliation and how we can understand the difference between the value on the bank statement and the values on our records. And by the way, both of them might be incorrect, and we need to adjust our records to make sure that it meets the updated bank statement balance.